Welcome back to AlgoBot, your channel for exploring automated trading strategies for MetaTrader 5. I'm your host here at AlgoBot, and today we're taking a close, analytical look at an expert advisor called the Opposing Volume Dominance Pivot. This is a trend resumption strategy built around a pocket pivot idea where tick volume tells much of the story. It leans on an exponential moving average baseline to define the trend, and on a volume comparison to time its entries. By the end of this video, you'll understand how it reads volume, how it defines a pullback, and how it manages risk. Everything here is educational only. Let's dive in. The Opposing Volume Dominance Pivot is an expert advisor that automates a very specific idea about volume. Most volume filters compare the current bar to an average or accumulate a running total the way on balance volume does. This strategy asks a sharper question. It looks at whether a with-trend bar's tick volume has just exceeded the single strongest opposing color bar in the recent look-back window. When a bullish bar prints more tick volume than the largest down bar of the last several bars, the heaviest recent selling has been absorbed and outpaced by buying in one bar. That footprint is often described as accumulation. The mirror image applies to a bearish bar that exceeds the largest up bar, a footprint often described as distribution. Because volume alone can be noisy, the strategy wraps that signal in structure. An exponential moving average, by default a 30-period line, defines the regime. Long setups require price to be above a rising average, and short setups require price to be below a falling average. On top of that, the strategy only acts on a pullback. The signal bar must dip back toward the baseline, coming within a fraction of the average true range of the moving average. So the entry is a resumption off the mean rather than a chase of an already extended move. This approach is built with liquid instruments in mind, such as major foreign exchange pairs, metals, and indices, and it's designed for intraday to swing timeframes, roughly 5 minutes through 1 hour. It's not locked to a single time frame, so it runs on whatever chart period you select. It suits a trader who is curious about volume-based confirmation and who prefers a rules-based, volatility-scaled framework over discretionary decisions. As always, this is an educational breakdown, not financial advice, and trading carries real risk, including the risk of loss. Let's walk through the exact logic, step by step. The expert advisor works on closed bars, so it evaluates its rules once per newly completed candle on whatever time frame you attach it to. First, it checks housekeeping. It allows only one open position per magic number at a time, and it skips new entries when the spread is wider than the maximum spread setting, which defaults to 80 points. Next comes the trend filter. The strategy calculates an exponential moving average of the close, and it compares that average now against the average a few bars ago, 3 bars by default, to read the slope. If the average is rising, only long setups are considered. If it's falling, only shorts are considered. This keeps the strategy aligned with the prevailing direction. Then it measures volatility using the average true range over its look-back period, 14 bars by default. This single value does double duty. It defines how deep a pullback must be, and it scales the stop and target later on. Now the core signal. The strategy inspects the just closed bar. For a long, that bar must be bullish, closing above its open, and it must close above the rising average. It must also have pulled back, meaning its low dip to within the pullback multiple, 0.8 by default, times the average true range of the baseline. Finally comes the dominance test. The bar's tick volume must exceed the strongest down bar in the look-back window, and it must also clear the volume factor times the window's average volume. That second clause ensures that even a quiet window with no opposing bars still needs a genuine volume surge, not a trivial one. The short side is a perfect mirror. The signal bar must be bearish, close below a falling average, have its high reach up into the baseline zone, and print tick volume that exceeds the strongest up bar and the volume threshold. When a long signal is confirmed, the expert advisor buys at the ask. The stop loss is placed the stop multiple, 1.5 by default, times the average true range below entry, and the take profit is set at the reward-to-risk ratio, 1.8 by default, times that stop distance above entry. For a short, the logic flips, selling at the bid with the stop above and the target below. From there, the volatility bracket manages the trade to completion. There is no separate trailing routine. The stop and target do all the work. Here's the heart of the strategy as it appears in MetaEditor. At the top, you can see the input parameters. EmaPeriod, defaulting to 30, sets the trend baseline. TrendSlopeBars, 3, is how far back the average is compared to read its slope. VolLookback, 10, is the window scan for the strongest opposing color volume. VolFactor, 1.0, is the multiple of average volume the signal must clear. Pullback ATR multiple, 0.8, controls how close to the baseline the bar must pull. ATR-period, ATR-stop multiple, and reward-risk ratio govern volatility and the risk bracket and max spread points, lots, and magic round-out execution. Below the inputs is the long block. Read the condition out loud with me. The bar is bullish, its close is above the moving average. The average is rising. Its low has pulled back within the pullback multiple times the average true range of the average, and its tick volume exceeds both the strongest downbar volume and the volume threshold. When all of that is true, the code computes the risk as the stop multiple times the average true range, sets the stop loss below entry and the take profit at the reward to risk multiple above it, and calls trade.buy. The short block, just beneath it, is the exact mirror. The bar is bearish, closing below a falling average. Its high reaches up into the baseline zone, and its volume exceeds the strongest up bar and the threshold. The stop loss sits above entry, the take profit below, and the code calls trade.sell. Notice that both sides share the identical volatility-scaled math, which keeps the long and short behavior symmetric. Let's bring the logic to life on the chart. On screen, you can see a candlestick sequence with the exponential moving average baseline drawn as a line through price, and a tick volume panel underneath. Watch how the strategy reads these two together. We begin in a healthy uptrend. In the first two candles, price is trading above the moving average, and that average is sloping upward, so the strategy's trend filter is now open to long setups only. But it does not buy strength here, because there has been no pullback and no volume signature yet. Now notice the next couple of candles ease lower, back toward the baseline. This is exactly the pullback the strategy waits for. Price drifts down until a candle's low dips into the zone within a fraction of the average true range of the moving average. The market has returned to its mean inside an uptrend. The stage is set. Then comes the key candle at the buy entry marker. It's a bullish bar that closes back above the rising average. And, crucially, look at the volume panel. Its tick volume towers over the tallest opposing, down-colored bar in the look-back window, and it clears the average volume threshold as well, lifting into the dominant volume zone. In the strategy's terms, demand has just absorbed and outpaced the heaviest recent selling in a single bar. That is the dominance condition, and the expert advisor places its buy at the entry marker. At the same moment, a stop loss is set below entry at the volatility distance, and a take profit is projected above using the reward-to-risk ratio of 1.8. From there, price resumes the trend. The following candles push higher, candle after candle, riding the demand that showed up at the pivot. Price climbs steadily until it reaches the take-profit target, where the long trade closes. Notice the trade was managed entirely by that fixed bracket, with no discretionary exit. Now the character of the market changes. Around the peak, price rolls over, and the moving average flattens and begins to slope down. The trend filter has flipped. From here, the strategy will only consider shorts. Watch the pullback repeat in mirror image. Price ticks back up toward the now falling average, and a candle's high pushes into the baseline zone from below. Price has returned to its mean inside a downtrend. Then the short signal candle prints at the sell entry marker. It's a bearish bar closing below the falling average, and again the volume panel tells the story. Its tick volume exceeds the strongest up-colored bar in the window and clears the threshold, once more entering the dominant volume zone. Supply has overpowered the strongest recent buying in one bar, the distribution footprint, and the expert advisor places its sell at the entry marker. The stop loss sits above entry and the take profit is projected below, again at the reward-to-risk multiple. Price then follows through to the downside. The final candles step lower, one after another, until price reaches the short take-profit target, and that trade closes as well. Across both trades, notice the common thread. The strategy never chased the move. It waited for the trend to define direction, for price to pull back to the baseline, and for one decisive bar whose volume overwhelmed the strongest opposing bar. Only when all three lined up did it act. And in every case, the volatility-scaled stop and target defined the outcome in advance. That brings us to the end of our breakdown of the opposing volume dominance pivot. We covered the core idea, comparing a with-trend bar's tick volume against the strongest opposing bar, and we saw how the moving average trend filter, the pullback gate, and the volatility-scaled risk bracket fit together on both the long and the short side. We also walked through the actual MQL5 code and a candle-by-candle chart example. Remember, everything in this video is for educational purposes only and is not financial advice. Trading involves real risk, and losses do occur. If you found this analysis helpful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment with a strategy you'd like us to examine next. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.